Hello, fellow intelligent investors. My name is René Zellman, and on this channel I provide tips and tricks that should help you how to find high-quality enterprises or companies that are available at a fair price and that you can then hold for the long term. In this particular video, I will point out one of the most common reasons why investors lose money in the stock market. Bear in mind that the most important rule every investor or stock picker needs to internalize is that your main task is to avoid a permanent loss of capital. This is what Buffett refers to as rule number one. According to him, rule number one is not to lose money, and rule number two is not to forget rule number one. And with that being said, let's run the intro and get started.
Have you ever wondered how you can make your hard-earned money work for you? Have you ever dreamed of building generational wealth and leaving a legacy? My name is René Zellman, and I'll teach you how you can manage and invest your money with confidence, a long-term vision, and without losing your mind. Join me on my journey of intelligent investing and learn how smart people can compound their money effectively and accumulate wealth.
Okay, before I tell you what I think is a very common reason why investors lose money in the stock market, let me know in the comments down below what you think. Why do people lose money in the stock market? Personally, I think one of the biggest mistakes an investor can make is to try to get rich quick and not to take a long-term view. Ultimately, a short-term focus and a desire for quick profits can and often will lead to losses. But unfortunately, it is our human nature to want immediate gratification. And due to this human tendency, by far the hardest part in investing is probably to accept that it takes time. In my view, there are way too many people putting money into the stock market that try to get rich quick. People that do not actually know what they are doing. And especially in today's day and age, there are more get-rich-quick schemes than ever, I guess, that kind of incentivize this short-term focus and behavior. Gurus are trying to sell you the dream of making hundreds of thousands, if not millions of dollars in a fairly short period of time. And unfortunately, there are way too many folks believing them. And I can only warn you, don't fall for these scammers. In the world of investing, people promising you to get rich quick are mostly trading gurus. They will argue that you can consistently achieve returns of over 50%. We're speaking of 50% annually by trading cryptocurrencies, stocks, or foreign currencies. I've seen videos of people on TikTok claiming that 20% per week is doable. But trust me, this is nonsense. These kinds of results are ridiculous, and I have yet to meet a trader that can consistently beat the long-term performance of an intelligent investor with a long-term focus and a low turnover rate, someone that selectively invests in superior businesses. In fact, around 20% of retail traders that are speculating in non-productive assets like gold, Bitcoin, or foreign currencies are barely profitable, and the other 80% are losing money. And this makes sense if you think about it, because the underlying asset, for instance gold or cryptocurrencies, they don't produce any profits and they aren't growing. And even if they invest in actual businesses, aka stocks, the major risk of having a get-rich-quick mentality is that people start treating stocks like a lottery ticket or poker chips. They simply buy a stock and hope that they will win. They hope that they can successfully trade in and out of investments, and they hope that the investment will turn out to be the next Apple, Adobe, Facebook, Activision, or Domino's Pizza and become a 100-bagger. A 100-bagger is what we refer to as a stock that returns $100 for every $1 invested. But clearly, hope is a bad investment strategy. Having a lottery ticket or casino attitude may also explain why every once in a while stock prices can become excessively high relative to what the underlying businesses are worth. In fact, get-rich-quick investors are often attracted to individual stocks that have performed exceptionally well in the past. They look at their stock price history, but pay no attention to the performance of the underlying company. Just look at this year's price performance of stocks like Tesla, Hertz, by the way, a company that filed for bankruptcy, or Nikola. The price performance has absolutely nothing to do with the performance of the underlying business. But rallies in the firms filing for Chapter 11 bankruptcy and sky-high valuations based on blind speculation and recommendations that you have received on Reddit or Twitter are dangerous. They are dangerous especially for those that don't know what they are doing. Stocks that have significantly increased in price over a fairly short period of time, say a few months or a year or two, are seen as attractive investments, and the annual returns so far have been spectacular. As a matter of fact, in psychology, there is a term for this human tendency. It's the so-called anchoring bias. Very briefly speaking, anchoring bias is a cognitive bias that causes us to rely too heavily on the first piece of information we can get our hands on. And in the world of stocks, anchoring bias refers to the human tendency to use the past stock price as a reference point. And this ultimately influences decision making. What people suffering from this bias need to acknowledge, though, is that price and value are different. I would argue that people who understand the difference between price and value enjoy a significant advantage in the stock market. On a side note, this channel is relatively new. It's only my second video. So if you like my content, you should at least consider hitting the thumbs up button or the subscribe button. Clearly, people investing in excessively valued companies that have performed tremendously well in the recent past lack knowledge and aren't aware that the stock price doesn't necessarily reflect the value of the firm. That's why they aren't investing. They are speculating. Whenever you buy something and don't know what it is worth, again, the value is not the daily quote that you can find in your investing app. So the value of the firm. Whenever you do that, you are speculating. You're essentially hoping that eventually someone else will pay you more than you paid for it. Now, I should point out that if you buy a stock that is trading significantly above the firm's actual worth, you are destined to lose money. But investors with a gambling mentality will typically find any excuse to justify why the stock's price should continue to go up. Again, just take a look at the ridiculous projections about Tesla's future runway for growth that people share on Twitter. It's fairly entertaining, to be honest. With that being said, I believe that investors not only need to look at the underlying business, but they also need to take a long-term perspective. If they want to achieve their financial goals, they need to accept that it takes time to accumulate wealth. In investing, there are 4 variables that will determine whether you make it or break it. I believe that every prospective investor should be familiar with these 4 parameters. So let me just very briefly mention them. The first variable is your starting capital. It should come as no surprise that someone starting with $100,000 will achieve his financial goals more quickly than someone starting with $0 who has the same financial goals. The second parameter that will impact your financial success is the amount of money that you are able to invest regularly. Again, it should be obvious that someone who can put aside $2,000 each month will get to a net worth of, say, $500,000 more quickly than another person who can only invest $100 each month. This second parameter is affected by both your savings ratio, but also by your income, of course. Thirdly, another variable that will have a significant impact on your wealth building process is the annualized rate of return that you can achieve. That's the geometric average amount of money earned by your investments each year over a given time period. Let's use a simple compound interest calculator such as the calculatorsite.com to illustrate this. Let's consider 2 people. Steve starts with $0, but eventually starts to invest $500 per month into a REIT. And he will do this for 20 years. REITs must pay out at least 90% of their earnings to shareholders as dividends. So let's assume Steve will reinvest these dividends. Let's say that his average rate of return over the 20-year period is 5% annually. After 20 years, Steve will end up with roughly $190,000. By contrast, Stephanie, who also starts with $0 and also plans to invest $500 on a monthly basis, invests into the S&P 500 index fund and is able to achieve a compounded growth rate of 10% annually. After 20 years, Stephanie's net worth will have grown to $340,000. This is almost twice as much as what Steve has after the 20-year period. And the difference between their performance would become even more significant if we would increase the time period. This brings us to the fourth variable. And the fourth variable is time. Let me tell you a secret here. The time you have to invest is by far the most powerful wealth building tool and the most valuable asset you have. The secret to getting rich is the miracle of compound interest. By investing in companies that are growing, an initial investment could multiply many times over over the course of a long time span. Don't underestimate the power of compound interest. Your long-term success can be, in a way, compared to an avalanche that starts as a tiny snowball, but it eventually becomes a massive force that smashes trees and destroys towns. On your personal and individual wealth building journey, you need to start as a tiny snowball at some point, and then try to roll that snowball for a long time. As one of my idols, Charlie Munger, once explained, getting wealthy is like rolling a snowball. It helps to start on the top of a long hill and to start rolling that snowball early. And if you do that for a long time, there's no way, but you will get rich. Let's illustrate this with a crazy example. Say John. John saved $200 per month from the time he turned 19 until he turned 26. For those counting at home, that's a period of 7 years. Then he stopped saving, but left his money in his investment account, where it continued to compound at a 10% rate until he retired, eventually at the age of 65. In contrast, Annabelle held off and didn't start saving and investing until age 26. When she turned 26, she also started to put away $200 per month and never stopped. Like John, she retired at age 65. However, over a 7-year period, John saved $16,800. Let me reiterate this. John simply stopped after 7 years of investing. Annabelle, on the other hand, saved $93,000 over a 39-year period. Sadly, for Annabelle, their ending balances weren't dramatically different. Believe it or not, while Annabelle accumulated $1,150,000, John ends up with $1,185,000. I mean, isn't that crazy? By starting early, John was able to better take advantage of compound interest. People who start their investing journey early in life can vastly outperform the late starters because they get the benefit of compounding growth over a longer period of time. Clearly, the contributions you make in the early years are much more important than the ones you make later in your life. Okay, before I start my conclusion, let me once again point out that you can also follow me on Instagram. I regularly share my knowledge over there, and if you would share this video with your friends and family, as I said previously, this would also help me out a great deal and maybe help me to crack the YouTube algorithm and also to reach more people. So let's wrap it up here. What's the key takeaway? The major takeaway here should be that your single biggest asset and advantage in the world of investing is having a long-term investment horizon. Patience is a virtue for an investor. Please don't try to get rich quick. Don't try to force it. This will not work. The people who do well investing are the people who compound over and over again. They achieve a decent rate of return and compound their money every year and keep doing this for a very long time. Again, just use a compound interest calculator and play around with it. If you can get an annual rate of return of 11 to 12% and invest for many years, you are destined to build wealth. In my opinion, to some extent, the desire to get rich quick can be considered a sign of immaturity. On the other hand, being willing to delay pleasure for a greater result in the future is a sign of maturity. By contrast, if you're looking for some kind of instant button, you're likely speculating and gambling with your money. Sorry for telling you, but you are not investing. You're not looking at the underlying fundamentals of a company, and do not come up with your own estimate of what the asset that you are buying is actually worth. So please don't let irrational logic dictate your buying and selling decisions. You need to realize that stocks are not just a piece of paper. Stocks represent an actual ownership stake in a company. And you should think of yourself as a business owner and not a speculator that hopes to get lucky eventually. Okay, let me end this video with one of my most favorite quotes. Tom Steyer once said, "If you do the math and think about it in any long-term way, the people who do well are the people who compound over and over again. Compound every year. Don't try and get rich quick. Try to get a decent return and keep doing it."